Good morning, and thank you for joining us for today's webinar, How Will New Lease Standards Impact You? We'll be getting started shortly, but first I want to take a minute to go over the format of today's webinar. All phones have been placed on mute. If you have any questions throughout the webinar, please use the Questions tab in the menu. We will address questions at the end of the webinar as time permits. We will also be recording this session, and the recording will be sent out tomorrow morning. If you're attending this webinar for CPE credit, you will need to answer all 3 polling questions and complete the post-webinar survey that will be emailed out tomorrow morning. Again, thank you for joining us. At this point, I would like to introduce today's presenters. As a partner in the firm's accounting and auditing department and industry leader of the firm's hospitality services group, Jen Hogenkamp has almost 20 years of public accounting experience in providing audit services to a wide array of clients, including those in hospitality, education, technology, manufacturing, and distribution industries. Jen works with some of the largest hospitality management companies in the country, as well as a number of nonprofit agencies specializing in audit services for educational institutions. She is also certified by the Hospitality, Financial, and Technology Professionals as a Certified Hospitality Accountant Executive. As a manager in Bloom's Accounting and Auditing Department, Steve French performs audit, review, and compilation services for a wide range of clients, including manufacturers, distributors, retailers, contractors, and nonprofit organizations. In this position, he performs all manager-level aspects of auditing engagements, including supervising field work and overseeing staff accountants. Katie Alford, a regional sales director with AMT Direct, has 10 years of accounting software experience across a wide range of verticals. She's also joined by Michael Emerson, Senior Sales Engineer from AMT Direct, with over 8 years of lease administration, in-depth knowledge of lease accounting. I'll now hand it over to Jen Hogenkamp to begin today's presentation.
Good morning, everyone, and thanks for joining us today. We're going to go through quite a few things on the webinar today, starting off with kind of an overview of the lease standards and a quick summary of how they might impact the financial statements and what you should be aware of. And then we're going to move into kind of what we've learned on a timeline from implementation and when you should start. And from our knowledge that we've gained from the public companies going through this, as well as clients that we currently have and what we've learned, we're going to go through some of the risks and challenges and the lessons learned from that, and then talk about whether or not to invest in software. So we at Bloom have put together a lease team internally, actually a couple of years ago when this was issued, when ASU 2016-02 came out, I think it was in February of 2016. So we've been working on this and really tried to get our arms around whether we needed to partner up with a software company. So we did a lot of research and through a lot of testing and partnered up with AMT Direct, who's also here today on the webinar with us. So they will be going through some of the software challenges and some of the things that they've also seen on the software side. If anyone has any questions, feel free to also ask the questions. There's going to be a bar on the side, and you can submit any questions that you might have. So just a couple quick stats. The public companies had to start implementing actually as of this year, as of Q1, if they were a calendar year. The ASU was for periods beginning after December 15, 2018 for public companies and December 15, 2019 for private companies. So like I mentioned before, there's been a lot of things that have been learned, lessons learned, but EY did a survey, and although a lot of public companies had implementation and process as of 12/31/18, there was still a large amount, if not almost all of the private companies that hadn't even assessed the impact or hadn't started down the path of understanding the impact of their company. And I think one of the reasons that we've heard is there were so many off-balance sheet liabilities, you know, that in the past were just part of the financial statements in the operating lease footnote or any of the other footnotes that were in there, that they wanted to get those commitments onto the balance sheet. And they're saying there's over $3 trillion off-balance sheet commitments that now want to go in onto the balance sheet. So Steve French, manager at the firm, is now going to go through an overview of the standard itself and how it's going to impact the financials.
Thanks, Jen. Good morning, everyone. So first thing is generally touched upon are the effective dates. So for, again, public entities, fiscal years beginning after 12/15/18, and for private entities, fiscal years beginning after 12/15/19. It's a modified retrospective approach. So at a point in time of implementation, the books recorded based on the future payments as of the balance sheet date. So if your year ends 12/31, as of 12/31/2020, the remaining lease balances are going to be recorded on the balance sheet, or 2019 if you're showing comparative. So now just a quick overview of the current accounting for leases. The capital or finance leases, they're already on the balance sheet as an asset and a liability. And a lease is a capital lease if it meets one of these four criteria. If there's a bargain purchase option at the end of the lease, if the lease life is 75% of the useful asset of the life, if title transfers at the end of the lease to the lessee, or if the present value of the minimum lease payments is greater than 90% of the cost of the asset if it was purchased. And then operating leases are currently not on the balance sheet. They're month to month on your P&L. And now we have our first poll question.
You should see the question up on your screen now. Again, if you are doing this webinar for CPE credit, you must answer all three of the polling questions, and this is the first one. We're going to leave this open for about another 10 or 15 seconds here just to get the last few of you in here. All right, thank you.
So it looks like, which is good news, 74% have said yes, they've actually thought about it, but that 26% no, so it's a good thing you're on this webinar today to kind of get a brief understanding. So I'll hand it back to Steve.
So on the next slide is, what industries are most affected by this new standard? And really it's any industry that is likely to have multiple operating facilities or will be renting or leasing equipment or machinery. So a lot of restaurant chains, manufacturers, and auto dealerships, not so much professional service firms. And now we're going to jump into the new guidance. So under the new guidance, both finance and operating leases are going to be recorded on the balance sheet as a right-of-use asset and a lease liability. However, the guidance still maintains a difference between operating and finance leases. So actually, when you're recording them on the balance sheet, they can't be grouped together into one line item as an asset and one line item as a liability. They need to be broken out as a right-of-use asset for your operating leases and a right-of-use asset for your finance leases, and the same on the liability side. The criteria of what makes a capital lease is more or less the same with a couple small differences. One related to the bargain purchase option. Not only does it have to have a bargain purchase option, but it has to be likely exercised by the lessee. And then there's also one additional criteria that's coming out, and that is if the underlying asset is so specialized in nature that it's not going to have any alternative use for the lessor once the lease is up, that's going to push you into having a capital lease as well. So on the next slide, we're going to go into the actual definition of the lease, which has changed with this new standard. So the new definition is a contract or part of a contract that conveys the right to control the use of an identified property, plant, or equipment for a period of time in exchange for consideration. And the key in this definition is to have the control of that underlying asset. So a lot of these agreements still need to be evaluated or reevaluated to determine if a lease actually exists in the agreements. Just because something says it's a lease doesn't make it a lease. And on the other side, if an agreement doesn't say it's a lease, it may in fact be a lease. So one quick example we have on this is, so say you're a company and you are renting a vending machine from Coke, and in the agreement it says, you can only have Coke soda products in here. We will come in and refill this vending machine once every other week. And anytime there needs to be repairs, you have to use one of our approved vendors. So there's really no control from the company that's renting or leasing this vending machine, so it doesn't end up being a lease. And vice versa, if you rented that vending machine but had the option to go through Coke or Pepsi or put candy bars in there and use any vendor you wanted, the company does have control over what they can do with that machine, which would create a lease.
One of the things that I think we've been seeing in practice is, and we'll talk about it later on because there is a practical expedient that you can use for private companies, but there's a lot of service contracts and rental agreements that might contain a lease that never did before. So reassessing and pulling out all the documentation and the contracts, whether it says lease or not, to make sure that you're gathering all the documentation on all the leases that weren't there.
So the next slide, just a brief picture on how it's actually going to look on your financial statements. And as I stated before, so for the balance sheet, you're going to have a separate right of use asset and lease liability for your finance leases, and then also the same asset and liability for your operating leases. On the income statement for your finance, you're going to have amortization expense for that asset and then interest expense related to the payments. And for operating leases, it's just going to be a single straight line expense item on the P&L. And for finance on the cash flow, it's going to be between financing and operating. And for operating, it's going to stay in the operating section. So now we're going to get into how to actually calculate the lease liability and the right of use asset. So first, you're going to start with your lease liability, and that is going to equal the present value of the lease payments. And obviously, all the leases can be different. You may run into fixed payments. There could be variable lease payments based on escalating rent, whether it be percentage or dollar increase, and also something to consider if there is a purchase option at the end of the lease. If it's likely that that's going to be exercised, that also needs to be included in the calculation. And the discount rate to use to get back to the present value is going to be the rate that is implicit in the agreement or readily determinable. And if there is nothing that is readily determinable, you can use an incremental borrowing rate or adopt a practical expedient where you can use the risk-free borrowing rate. And this brings us to how to actually calculate the right of use asset. So starting here, you're going to start with your lease liability, and you're going to add any initial direct costs. And what those costs are is anything that would not have been incurred unless the lease was actually signed and went into. So if you had legal costs for reviewing contracts or travel to go visit a location that you may think about leasing, those would not be capitalized or included in the calculation because you're going to incur those costs whether you end up signing the lease or not. From there, you would subtract out any lease incentives, most common one being, maybe you have some free rent on the beginning of your lease, and then add any prepayments towards your lease. So some other items just to point out, the first one being lease term for the right of use asset. So if the lease agreement is less than 12 months in nature, it doesn't have to be converted to the balance sheet. And then also the bigger portion being, not only are you going to have to use the current term in your lease, but you also have to consider the extension options when looking at your lease. So if you have a lease with a 5-year current term and there's 2 5-year options, and you talk, and you're going to be there for all those 15 years, all 15 years have to be included in the calculation of that right of use asset and lease liability. So it can create a massive asset and liability on your balance sheet. Other items being lease modifications, as generally touched upon, to be reassessed. There may be new leases and existing agreements. Lease and non-lease components need to be segregated, so that mainly relates to CAM charges. They can be broken out onto the P&L, or they can also be capitalized into this asset and liability. Taxes and insurance are already broken out separately, so those don't need to be considered. And the last point is the lesser accounting has remained relatively unchanged.
I think that the breakout has been a problem in the past for some companies, because sometimes the understanding the allocation of what the CAM charges might be, because sometimes they're embedded in the lease agreement. So if you pay $5,000 a month and that's your lease payment for the month, understanding what the CAM charge portion might be, because it might not be stipulated in the lease, has been tough for some companies to understand. So just being aware that sometimes it might be easier, but then the classification can be tough.
So the next slide, and something we've been hearing a lot of questions about, and it's a little bit of a gray area, is related party leases and how to account for those and whether they need to be put on the balance sheet. And a lot of related party leases are companies, they may not have an actual agreement in place, or they may be month to month. So we've been hearing the question, well, if my lease is month to month, it's technically less than a year, or can be less than a year, do I need to record it on the balance sheet? And the answer we've been finding and suggesting is yes. So each lease really needs to be assessed and assess the economics of that, and it could be a simple conversation of how long do we think we're going to be in this location, and you calculate based on that. A couple other options being, have significant improvements been made on this, the lease location, that showing intention that they're going to stay there for a period of time. How long would it actually take for the current company to move out and the owner of the property to find someone else to come in? All those things could be considered when trying to figure out a term to use to record it on the balance sheet.
I think one great example of that is we had a client that had it was a manufacturing company that had equipment bolted to the floor, and it's a month-to-month lease, but the cost and the moving that equipment might take a year, it might take a long time. So you can't say, or maybe there's licenses that you need to get if you have specific equipment that you have to move, or there's not an easy way to do it. So even though it's a related party lease and it's on a month-to-month basis, you still have to take into account the economics of physically moving, and if that would actually happen or be able to happen if you have to get new permits or leases or licenses in effect before you could actually move. So it's not a very simple thing just to say it's month to month.
Right, and then also going back to, if there is no agreement, we would suggest that a lease contract be written for those agreements as well. And the last slide I will be talking before I hand it back over to Jen are the debt covenant impacts. So obviously there could be a significant increase in your asset and liabilities, which is going to change the calculation of your covenant ratios, and whether it be debt to equity or your leverage ratios, your EBITDA is going to increase. Lenders and companies and CPAs all need to be on the same page and aware of what's going on, so that when your year end comes up and it's time to do your covenant calculation, we're prepared and nothing's going to get held up and maybe put to a waiver. So one idea that is coming up is frozen gap, which is pretty much saying that the covenant requirements are going to stay the same, and you're going to calculate the covenant based on activity prior to this lease implementation, so excluding the right of use asset and liability on the books.
And the problem with that becomes year after year, you're going to have to continue to get a waiver, and at some point, if there's a new debt agreement signed, at some point you're probably going to have to implement anyway, because unless you continue with that frozen gap, it's kind of difficult. Once we did, at Bloom, have a lot of discussions with the banks to update them on this standard, and I would encourage, if anybody that's on the phone or any company that hasn't had that conversation yet and does have covenants, I wouldn't suggest that they know that this is in the pipeline. Most of the bigger banks do. A lot of the smaller banks aren't aware of the impact of this on the covenants in their financials. So maybe start to have that conversation now. On the practical expedient side, so
we have our second poll question.
Oh, sorry.
Again, this is the second poll question out of 3. If you're attending for CPE credit, you must answer this question. Give about another 15 seconds or so here for everyone else to get their selection in. All right, thank you, everybody.
So poll question number 2, 74%, very similar results as the first question, said no, that they had not put into effect an implementation plan yet. So maybe it's something to start thinking about. Definitely, we'll get into that in a second. So quickly, we wanted to touch upon, if you are a private company, there are practical expedients that you can adopt upon implementation. And some of those, the first 3 you have to do as a package, so it's got to be all or nothing. And those relate to the prior lease classification. So if you originally had capital leases and operating leases, you do not have to go back and reassess those. You also would not have to reassess contracts that have already been entered into, whether they have embedded leases or not, and you would also not have to reassess initial direct costs that have been incurred in the past. So you can adopt all 3 of those or not. And a couple other practical expedients, I think Steve touched upon the short-term leases where you do not have to assess any lease that is 12 months or less. You can adopt whether you are going to combine the lease and kind of those CAM charges into one and capitalize those. There are some instances where some public companies have done that. The tracking of that becomes a little tedious on the software side, but it is a practical expedient for private companies and makes it a little bit easier so you don't have to do that allocation. And then the last one is the discount rates. So private companies, typically you can either use the rate that's embedded in the lease and is stated in the lease. You can use the incremental borrowing rate that you would use for that term of that lease as it currently sits, or you can default and take the practical expedient to use the risk-free borrowing rate, which would be, we're using the U.S. Treasury rate. And it would be, if you have a 5-year lease and you intend for it to go 5 additional years, so you have a 10-year lease, it would be from the date you signed it, what that 10-year incremental or the U.S. Treasury risk-free rate was for 10 years for that period. So you have to assess each contract separately. You can bundle them together. We're not going to get into that right now, but there are some other ways to do it, just so you're aware. So now we're going to start to kind of get into the timeline. And I think one of the lessons learned was that for public companies, it did take a lot longer to implement than they initially anticipated. Katie's going to get into that a little bit more. But typically it was done in 2 phases. So you have your data collection phase where you're gathering all your leases, you're understanding whether there was embedded leases in some of your other service contracts or rental agreements, and you're trying to get all of the departments together, which can be a significant undertaking, especially if you have multiple locations across the country, internationally, whatever it might be. That data collection process, and then also establishing policies and procedures on an ongoing basis. How is the accounting department going to be able to get their hands on any new agreements that could be signed in a different country, or what practices are you going to follow to ensure that all of the collection of leases have been correctly assessed? And so that's kind of phase 1, and then phase 2 is the extraction and implementation. And for some companies where they have very few leases, it was might be a relatively simple process. But if you have multiple leases, multiple locations, multiple equipment leases or real estate leases, that understanding of that, which I'm going to allow Katie to get into, using a software product versus Excel, there were several public companies that went down that Excel path and are now learning. I think that might have gotten them through implementation for year 1, but they're reassessing that year 2. And because on the private company side, there's still a little bit of time, that assessment can start to happen. So now I'm going to pass it over to Michael, and then he can discuss the lessons learned.
Great. Thank you. Thank you very much, Jennifer, and good morning, everyone. So in terms of lessons learned, this is it's really interesting area for me because as I work with different companies and we're more kind of on that process of, hey, what's going to happen? So really where we are right now within this presentation. But we've also got the experience of implementing people and the lessons learned. And the first and probably most important one is going to be that the data collection may be tricky. From a process of capturing real estate information, it's usually pretty straightforward. People, have some sort of grasp on their real estate portfolio from a leasing standpoint. Whether it's in Excel, Access, on paper, they have a good understanding of it. It's when you start to get into all of the different other types of contracts that people and organizations really just don't have any idea where those contracts reside. If it's healthcare, you have doctors and biomedical departments that are leasing and renting equipment that those contracts are sitting in their drawer somewhere, and an amount is being paid out from their ERP system, but that contract isn't anywhere, or they have to track that information down. So one of the first areas of importance is to really start to collect that data, and then once you have that data, as said before, figuring out, hey, is this a contract? Is this an embedded lease? And then what is the lease component of that? What do I have to account for in those situations? So data collection is probably one of the biggest areas that people and organizations struggle with. And that's no different from, a small organization that might have 20 leases up to an organization that has, over 2,000 leases. There has been no difference that we've seen in the data collection process in terms of not having a full grasp of what's to come out of that. In addition to that, with some of your larger organizations, you're going to have multiple locations. And for the longest time, those locations have been operating in a decentralized fashion, meaning they've got their own accounting system. Sometimes they have their own, ERP systems, or it's gone through consolidations and acquisitions, and they've never kind of brought everything together. So having that information in different areas is tricky because as an organization now, you're having to report across all of your leases, all of your contracts. So whether or not that determination is, hey, yes, we're centralized, no, we're decentralized. Okay, do you want to make everything centralized? And we are seeing a large group of organizations actually bringing that to a centralized process. One, because it's a single source of truth and can give you all that information, but really it's bringing control into the new leasing standards because it's just not as easy as it used to be. And now you've got to have some sort of controls, and we're going to talk some more about different departments and having those controls. But you want to make sure that all of those leases are captured. As I said before, and I'll use again the example of healthcare, the amount of mergers and acquisitions in healthcare and the amount of people who have the right to sign contracts is enormous. So you have to make sure that you're capturing all those, again, the service contracts and embedded leases, and then checking for completeness. Capturing the different elements from a aspect of, hey, what's my rent? What are my options going to be? Are they reasonably certain to exercise? Those are pretty straightforward, but when you start to get into things like initial direct costs, landlord allowances, prepayments, that's where, you've got to make sure you have that information as well. So it's a whole lot of data collection that goes into this. So what we're seeing is a lot of these organizations are working with a partner to kind of help them walk through those leases and pull out that specific information. Okay. Next area is make sure that you are including all impacted departments. I can't tell you the number of times I've been on a demo and I'm working with the accounting and the finance team, and I'm on my second or third demonstration with that organization, and all of a sudden they brought real estate in, and real estate has a system, or they don't want to use a system, whatever it may be, and it really offsets that process and can slow that process down. So it's always important to make sure that you do have every group that's going to be involved with that, and then every group that is going to have a contract or a lease in those situations: procurement, facilities, legal, treasury, finance, real estate. All those different groups have to come together. And then once those groups are together, establish your policies and procedures moving towards the future. So there's a whole lot of where it was just separation before. Departments worked on their own. Now we're having to see that consolidation work of the different groups. And so now when a real estate lease is entered, there's an impact on the accounting side, an impact on the reporting side. So who's going to control those changes? Is there going to be an approval process? Things like that are things you're going to want to start to think about when you're establishing those policies, to make sure that, hey, day one, yeah, this is great, we've got this information, but what happens on day two? What happens the next year when we start to bring in some additional leases, and how is that process going to look? Very important to get that process set in advance. As we move to the next slide, the internal and external cost. So time and people, and this kind of goes back to the different departments that are going to work together. You know, again, people say to us, well, who typically is managing this software? Because there sometimes has not been a lease administration or a contract administration software that is in place. So it's determining who's going to be doing that. First and foremost, you've got to have somebody that's in charge. You can't, you know, it's the old, you know, too many cooks in the kitchen. You've got to have one person that's in charge of the whole thing. You can have people from different areas, real estate, you know, facilities, wherever those contracts are coming in, to help work within that process. But you've got to have somebody that's going to be in charge of that, and determining that in advance, and making sure that they do have the proper amount of time to actually manage a project like that, because it can be, you know, time goes into it when it comes to, you know, reviewing different software applications, reviewing your policies. There's a lot of time that gets invested into this. I can tell you, on the opposite end of this, when you do implement, or if you do implement a software to manage this information, there is a huge benefit on the other side of this when it comes to having a single source of truth for that information, where all of your contracts, all of your leases are in a single database. All of your documents are retained in that database and can be accessed in one location. And then again, you've got those policies and procedures. Now, maybe you're not going to miss a critical date notification or a renewal notice, because now you have renewal notice reminders coming into you. So there's a lot of benefits. And again, with the different departments that are working together, you know, it is a lot of work up front, but again, in the long run, there's going to be a huge benefit that comes with that. That brings us to software selection. If you do decide to select a software to work with, and as was said before, you know, there were some public companies that determined, hey, we're going to try this in Excel. For the most part, it's not that difficult to manage leases. People have been doing it for a long time in Excel. Where the difficulty comes in that people don't really think about is from the standpoint of, okay, well, what happens during a midterm adjustment to that lease? Or, you know, a year down the line, somebody realizes there was an error in something that was selected, and now we have to go back retroactively to select, you know, to update that information, and then create all those retro adjustments and the retroactive journal entries. That's a big process and a very complicated process that it's not just a simple formula. There are a lot of calculations. Believe me, I've seen it on the back end, a lot of calculations that go into the schedules that are being generated, especially when there's a revision that takes place. you're going to want to select a software vendor to work with. I'm obviously partial to a particular software vendor, but you are going to want to work with somebody. In the long run, it's going to pay off a lot more than trying to pull it off for yourself. And training and educating the internal resources. As someone that works for a software vendor, it's very frustrating for me to see an organization invest so much money into software and money into implementation and not into training and educating the internal resources, because those are the people that are going to be using this data. They're the ones that are going to be managing the information, and if they're not trained properly, training that's not proper or education that's not fulfilled leads to a dissatisfaction of the application or the software, which leads to, hey, I'm going to capture this over here, and then all of a sudden you're back to where you were prior to day one of changing over. So very important to train and educate the people that are going to use the application or whatever process it is that you're taking. If we move on to the last slide here in terms of lessons learned, as I said before, there are many inputs to consider. It's not just your payment, it's your options, it's your initial direct cost, landlord allowances. Then you have things like partial terminations of space, rights to purchase. All of those things now have to be considered when you're doing that, and they're all going to define whether that is a finance lease or an operating lease. Your discount rates need to be decided as far as how you're going to do that. Again, when I'm doing demonstrations and presentations prior to somebody selecting that, I always ask the accounting team, hey, have you determined what you're going to use for your discount rates? And the majority of the time, it's probably similar to how these polls are responding, where 75% have not determined what they're going to do. Some are going to use that treasury rate. Some are going to use their own interest rates. And you keep in mind, you may have different borrowing rates for different types of leases or different entities or decentralized areas. So it's not just a factor of saying, hey, this is a 5-year lease and it's 6% interest. There's a lot of factors that go into that. So I encourage you to start to think about that and talk about that now. Your variable versus your fixed payments. So this is going to be your CAM charges versus your base rent information. And exactly what it says below, this can become a bookkeeping nightmare because there are times that is a gross lease, a gross payment where that's all considered under one area. So you want to make sure that you're able to break out those specific items, working with your consultants in those situations, or using just the information off of a lease. Hey, sometimes the lease will actually state what those CAM charges are. So in those situations, it's a lot easier when things are, described or embedded inside of a lease. It's where it's not, and there's room for discretion as far as what you're going to use. And then your insurance, your real estate taxes, those are things that are non-lease components, but they do get tricky in those situations. For the longest time, and I'll just give you an example here, parking. Parking is included a lot of times in hospitals and education, higher education, which is not a lease component until it becomes a reserved parking space. It's an explicit use to you. Those are situations that you have to review within your leases as well. And then the materiality determination, whether or not you're going to include all or exclude your immaterial contracts into your either software or whatever process it is that you're taking. So I hope that you were able to get a good grasp of some of the lessons that we've seen and lessons learned from our current customers. And right now I'm going to turn it over to my counterpart, Katie, to talk about some other areas of not using software.
Good morning. Thank you, Michael. This is Katie. So I'm going to walk through, we just went through lessons learned, and I'm going to discuss kind of some of the risks of using Excel for lease accounting compliance. So The public companies, as we've talked about during this webinar, have kind of been the guinea pigs this year. So we definitely had some clients that, started off with Excel, but we're seeing a lot of clients moving forward and, evaluating softwares now just due to some of these reasons. So the first being the lack of system intelligence. So you can get all of your information into Excel, and it's a great tool, but it's not going to actually accurately interpret all the details of a lease. So examples of that would be contingent rent, identifying a lease, and then the non-lease components. It doesn't have the ability to really, help you and assist you with that. The second area is lack of control, and this is a very important area because control is obviously important in regards to a compliance situation. So what we're needing to do in this case is produce compliance reporting. So it doesn't have those key controls to ensure that integrity of your data. This is very important because you all know that the auditors are going to be very interested in seeing those schedules. So they're going to be very granular, looking at the audit trail to know who is responsible for all the changes, why changes were made. Unfortunately, again, Excel doesn't have the capability to really timestamp that, see who's making those changes to any of the leases. And then the other area of control is manual data entry. So we all know that when you do something manually, there is a chance that there's going to be an error. And a lot of times you're doing dual entry in regards to Excel, so there's a chance that you would make an error in regards to what you enter into Excel. Another risk of Excel is just the flexibility, and Michael brought this up a little bit earlier. So I think one of the main reasons that I've seen clients come, to us is due to the revision. So that's really the important part, is that you're going to have to be having some times where your lease is going to change and you're going to have to make those revisions and reassess the schedule. So lease accounting software can do this automatically for you when your GL changes and everyday events occur. Excel doesn't have that capability. And then lack of integration. So, we do have to get that lease scheduled for your auditors, but then there's also offsetting your general ledger entries for the right of use asset to consider. So that's another area. And then having the ability just to have an integrated lease accounting solution, it will streamline that process between the journal entries and reduces, again, the opportunity for error. So the big key here is, making sure that you don't have errors in regards to this important compliance.
So we've got the third poll question up again. If you're attending this for CPE, please make sure you answer this question. It's the final one here. We're going to leave it open for about another 10 or 15 seconds here to get in your last selection. All right. Thank you, everyone.
So it looks like the issues are pretty spread. Lack of system intelligence got 34%, 30% lack of control, and about 30% lack of integration. So it's pretty spread across, all the options.
Yeah, that makes sense. I mean, that's what we're seeing out there is all those reasons are reasons why people kind of feel that they may need to go with more of a software approach on this guidance. So we are going to finish it off with why software is the way to go. So the first reason is just scalability. This last year, we've had clients come on with 10 leases, clients with over 1,000. So every client's different. The important thing is that your business may be growing and you may need assistance with more complex situations. So you may have lessee, lessor, sublease situations, master leases, embedded leases. It gets more complicated as you kind of go through the data collection process. So a software, any type of software really can be scalable in regards to your portfolio. Michael mentioned earlier more of the automation of it. So you're going to be getting notifications for your critical dates. So you will be avoiding, if there's a time, I'm not sure if anyone out there has ever missed a renewal or had to overpay. The good thing with having the system to provide you those notifications is great in regards to the critical dates. And then you're also going to be gaining access to your journal entry and accounting schedule approval workflows. So we were talking about just the different parties involved earlier. A lot of times now people will put in place a workflow in regards to the accounting and the real estate side. So maybe the real estate side brings in the lease, and then it goes over to accounting to approve and add the data points needed to produce the schedule. And then the ability to integrate. So you will have the ability, if you'd like, to integrate your lease data with your existing ERP system. So we talked about kind of a source of truth where all of the leases lie. That's where your single repository will be, and then it will actually seamlessly integrate with your ERP system. And then at the end of the day, the most important thing is compliance. You're going to want to be getting those reports and the disclosures out to give to your auditors. You want them to be correct and compliant and have visibility of all of that. And your auditors are going to want all of that. So the reporting is, you can get all of your information in, you can abstract your leases in and make sure all the information is correct, but the output is actually really probably the most important part. So with our software, you have access to over 300 customizable reports. All that information is there for your ASC 842, IFRS 16 disclosures. We have the lease level details for your auditors, the amortization by lease, and then your accounting forecast. So it's just, it's very helpful to have all of that at one place for you to be able to pull everything. Your auditors can actually log in, that's exactly kind of why we should move ahead with, I believe, a software.
Great. Well, thank you, Katie, Michael, and Steve. Hopefully everybody has learned a little bit about, the overview and how it's going to impact your companies. We have had, I do have a couple questions that came in that people have asked, and one of the questions is, what can I do now? What do I do to start, and where could be a starting point? And I think one of those obviously is data collection, and you can even input it into Excel, which will make it a lot easier for even if you're going to have somebody help you with extraction, or if you're going to even turn it over to a software company. But gathering the data can start now as soon as possible, and and extracting the important components, whether it be location or the base rent and all of those certain metrics that you're going to need. That's definitely something that you could start now.
Yeah, getting that list of those data points and working with, your trusted advisor, your partner, your CPA firm, really to get that list of all the data points that you're going to need. So we have the capability here to provide you with any of that information.
So if anybody has any other questions, please submit them. If you'd like a copy of the slide deck, I think feel free to reach out and we can get that to you. We can send it out to everyone that's been on the webinar. And thanks for your time today. And please feel free to reach out if you have any other questions or concerns.